Mark, let's start our conversation around the markets, a conversation in 3 minutes about what we're seeing out there at this point. And in fact, I'll start with commodities because we just had a headline coming through across the Bloomberg saying that European gas prices surged as much as 10% this morning. I can see on the right, just over to your right-hand side, I see that European gas benchmark has jumped onto the GMM as we see those gas prices once again go higher. This is a theme we will keep returning to as we head towards the winter, no doubt.
Yeah, very much so. Thanks for drawing attention to that right to the top of the page on the commodities column there. Look, the size and scopes for this energy move are just mind-boggling what we're seeing. And I think the point is to emphasize here that it's not just for now, it's not just for this winter, it's pricing for 1 year ahead. We're pricing Europe to be deep in an energy crisis a year from now at the height of next year's summer. This is a problem that's going to run and run, and as a result, I think it's completely underpriced in European assets. I realize it's a hard one to play for yields because obviously while it's a big inflation problem, it's also going to be a big growth problem, and that makes it complicated for the currency as well. But I think that ultimately European stocks have tremendous downside over the next 6 months.
Yeah, one of our colleagues, Valerie, telling me that German power, one of her charts suggesting German power hitting a 500% gain over the past year. We'll continue to return to these themes, no doubt. Let's get back to the China story. We headlined this, Mark, a cut in rates over in China. Not quite the cut at the durations that was anticipated by the markets. And so stocks going higher, but not by a huge amount.
Yes, what they did is they cut the long end by 5 basis points more than expected and the front end by 5 basis points less. It's important to emphasize these are pretty marginal moves here, and it's a slight tweaking of calibrations. So I wouldn't want to read too much into the surprise, but the message was, hey, we're providing a little bit more support for mortgage borrowers, a little bit less stress for the property sector where the real focus of pain has been over the past year. But ultimately, they're providing less support at the front end that's generally about risk sentiment and that boost for stocks. And that was quite an interesting message, but I wouldn't want to read too much into these very marginal tweaks.
Where have we got to in the Fed conversation over the past couple of weeks then, Mark? Because since the middle of June, we've seen a rally in stocks. A lot of people asking whether that has now lost its momentum, I suppose, as we get towards the end of August, and maybe last week raised questions in that regard. But this was all predicated on anticipating some kind of pivot from the Fed.
So the Fed speakers have been consistent about there is no chance of a Fed pivot, and I think that's the message we'll continue to get. Now, there is still debate or lack of consensus among the Fed members about how high rates need to get and how quickly, but I think everyone has been unanimous about the idea that if a pivot next year is just completely bonkers, and then therefore that has been slowly priced out. We still have this divergence between what the market is pricing and what the Fed is guiding in their dots and also in their communication, but ultimately the Fed is winning this battle, and I think it goes back to the old adage, don't fight the Fed. The market will eventually fully concede at the fact that the Fed is very, very unlikely to pivot next year, as has been priced.